Rick, thank you very much for joining us today. I'm looking forward to this discussion. The last time we spoke, it was a very broad discussion on resources, but today I want to focus exclusively on uranium. So my apologies to all the gold bugs out there. After all, uranium was the top performing commodity in 2023, up over 80%. And you've been involved in the uranium sector for many years now. You've witnessed a few different cycles. And I want to start right here and get your thoughts on how this cycle compares to the cycle that we saw in the early 2000s.
Well, that's a great question. By the way, thank you for having me back. I'm a James Conner and a Bloor Street Capital fan, so I'm delighted to be back with you. But back to the question, I suspect that this cycle will be more muted than the prior cycle, in the sense that the prior cycle occurred at the end of a 20-year bear market. And there was simply no capacity to increase supply as a consequence of a 20-year bear market. This market, to be sure, has room to run, because the simple fact that the uranium price has gone to $100 a pound doesn't increase supply. You need to find mines, you need to permit mines, you need to bring mines back under production. I would suggest in the next 18 months that supply will grow between 15 and 20 million pounds per annum from the restarts of both the Kazatomprom and the Cameco hot-stopped projects. It's important to note, though, that both companies have said that they won't restart idled capacity until they have enough material contracted for long enough in the term market that they earn a reasonable return on shareholders' capital. So I think what you're going to see is pricing discipline. The other thing about this market compared to the last market that's better than the last market is that we're seeing in this market a real return to prominence of the term market over the spot market. In the last market, both producers and consumers were hampered with no price certainty. What we're seeing very recently, perhaps as a consequence of Sprott buying up most of the surplus inventory that was available in the spot market, is that most transactions today are taking place in the term market. These term market offtake agreements give producers certainty around the pricing that they sell their material for. And they do the same thing for the utilities. But that also increases the visibility of the free cash flow to the producer, and it makes production financing easier to occur than would otherwise happen. What I think you're going to be able to see is that companies that wouldn't necessarily otherwise be able to obtain production financing, if they have term agreements with investment quality offtakers, Duke Power, the Southern Company, Ontario Hydro, they'll be able to take those agreements to financial intermediaries like Sprott or Orion or the Royal Bank of Canada, and projects that would have been unfinanceable in the last cycle, I think will be financeable in this cycle. So it will be different in the sense that there is more expertise. There is the benefit of the exploration that occurred last cycle. But the financial structure that we're going to see in the uranium business for the next 10 or 20 years is going to be, from an investor standpoint, much, much, much more sustainable.
Yeah, all very good points. The other element that I want to bring to your attention is, I also lived through that last cycle, but there was a level of speculation then that I don't see now. Like, there was hundreds of these junior companies. Would you agree with that?
You made a really good point, and I think that's healthy. In the last cycle, if you measure from trough to peak, the number of junior companies involved in the uranium business increased from 5, I own them all, to 500. Now, to put that in perspective, the number of teams capable of running a uranium company at the beginning of the cycle after a 20-year bear market was, in my estimation, between 10 and 15. At the beginning of the cycle, you had 5 companies competing for 15 management teams. Pretty good arithmetic. At the end of the cycle, you had 500 companies competing for 15 teams. Pretty bad arithmetic. In that sense, this market is much more sensible. At last count, there are 81 companies purporting to be in the uranium space, with still 15, perhaps 20 teams now capable of running a uranium company. So the probability that your junior has access to high quality leadership is now 1 in 4 or 1 in 5, down from something more like 1 in 50 at the peak of the last cycle. It's a much, much, much healthier circumstance out there. Of the 81 companies that we see on a global basis that purport to be in the uranium business, we think as many as 15 of them are relatively attractive. While that doesn't sound like a great headline number, if you compare it with the length and breadth of the junior mining market, it is fairly attractive.
Very good points. And I guess something else we should that might be a little bit different this time too is the geopolitics. Of course, we still have the fallout from the war in Ukraine and also the sanctions placed against Russia. And then, even the situation that's happening within the Red Sea, right? This is causing shipping delays in the movement of uranium throughout the world. But can you speak to that?
I think that's a bigger story than uranium. I think if you look back over the last 40 years, that we've benefited from a time of historically low global tensions. And I think that's true across commodities. What we're beginning to see now is the end of that era, which is unfortunate. You are looking, as an example, at the continued ascent of China. And China is doing precisely what the United States and Western Europe did in the 50s and 60s. They're looking to secure access to supply. That's what the Japanese did in the 70s or 80s. The Chinese aren't doing anything that we didn't do, but there's increasing competition. At the same time, as you suggest, that the outlook in geopolitics is becoming less friendly. Now, thus far, with regards to uranium, despite the fact that we're hostile to the Russians, American imports of reprocessed uranium increased by 50% last year. Thus far, we seem to have sanctions where nobody gets hurt. I suspect that the United States and Canada, among others, would like enrichment and re-enrichment capacity that isn't Russian. It's very, very clear to me, too, that the U.S. is looking for, whether it's smart or not, geopolitical security around supply of uranium. I personally believe that we have access, if we pay the right price, to Canadian uranium. That notwithstanding, our Congress seems to feel different. And while 5 years ago, as recently as 5 years ago, they were extremely hostile to uranium, now the U.S. Congress has decided to subsidize it. That says something about the perception of the geopolitical importance of uranium. I think the best testimony, though, to that, James, occurs by watching the Japanese actions. As a consequence of the Arab oil embargo in the early part of the 1970s, Japan Inc. came to the not-so-stunning conclusion that they needed energy security. And the only material that they could store enough of to power Japan was uranium. The energy density of uranium meant that Japan went from a standing start, an anti-nuclear country as a consequence of Hiroshima and Nagasaki, to having the second largest nuclear fleet in the world, specifically around energy security. The Japanese could store in one warehouse enough uranium to supply electricity to all of Japan for 5 years. You couldn't store that much coal, that much oil, that much natural gas, and you certainly couldn't store that much rain. Importantly, in terms of geopolitics and in terms of the carbon-free generation of baseload power, the big thinkers in the world, irrespective of their thoughts about uranium 5 years ago, have turned to it as a way to solve both geopolitical and carbon problems.
Yeah, very good point. And it's almost, you've raised a great point about what happened in Japan and now what's happening in China. And it's almost as if the US policymakers are totally oblivious to this, because the Chinese, the one thing they do very well, they think long term. They're thinking 25, 50, 75 years out, whereas we in the West or in North America, we tend to think about this week, next month, right? We're very short-sighted. And given that the US is the world's largest importer or user of uranium. I believe it's 50 million pounds a year, 20% of its grid comes from nuclear energy. You'd think they would be a lot more aggressive in acquiring it and trying to get ahead of the curve.
I think you've been too polite towards U.S. policymakers, ironically. I think they think as far as the next election cycle. And I think much more than other people realize, they think towards campaign contributions. H.L. Mencken famously said about American politics that elections were advanced auctions of stolen property. And I suspect if you're looking for long-term policy out of American policymakers, your long-term perspective is no longer than the presidential election cycle, which is 4 years. Sad but true.
Yes, yes. I could say the same thing about the country I live in. Anyhow, that's a good overview of the macro. Why don't we dive in now to the micro? And I want to focus more on your selection process and how you invest as an investor. You're famous for that. And I want to get a sense of how you invest. Are you just buying the Sprott Physical Trust? Are you looking at producers, developers, explorcos? What's your portfolio look like?
In my experience, commodity bull markets follow a predictable pattern, which is to say the commodity moves first. So if you would ask me 3 years ago what I was doing, that was pretty simple. I thought that the uranium price had to go from 20 to some number like 75. And the lowest risk way for me to play that was the Sprott Physical Uranium Trust. I had no operational risk. I had no human resources risk. I had no political risk. All I had to do was buy uranium and throw it in a warehouse. And in fact, Sprott would do it for me. So my portfolio, upon us taking over the Sprott Physical Uranium Trust from UPC, was simply to buy that vehicle. I believed the commodity had to go up, and the most direct way to play the game was to buy the commodity, which I did. It was wonderful. The uranium price doesn't have to go up anymore, although I think it will. I think that the market misunderstands the importance of the structure of the uranium market going from a spot market to a term market. And I think that the market doesn't understand the level of earnings visibility that the companies will enjoy 3 years from now or 4 years ago. So I believe that some of the companies, particularly because they've lagged the uranium price in the last 6 months, offer the ability to be very, very good 5 to 7 year holds. Make no mistake, the easy money in the uranium juniors has been made. When a commodity goes from hated to tolerated to attractive, the easy money's off the table. And the fact that the sort of 15 uranium juniors that we follow are uniformly up 300 or 400% has made it incumbent on me to sell enough of those positions that I recaptured my capital investment. And I sold enough too to pay the capital gains on the recapture. The easy money has been made. What you look at now will be structurally improved companies. There'll be companies like Cameco that not only increase their production by 15 million pounds, but increase that production with minimum sales prices locked in for 15 years. The stability in terms of free cash flow that this gives Cameco and the visibility in terms of forward earnings that this gives Bay Street when they're analyzing Cameco means that the whole landscape around uranium equity investing has changed, and changed remarkably for the better. In terms of what I look for in a junior, I start with relevant experience in uranium. If a company is headed by somebody who has failed in crypto, failed in gold, and failed in marijuana, there's a high probability that he or she is going to fail in uranium too. And I would prefer that they didn't take me with them. Mercifully, having been in the uranium business now for almost 40 years, most of the people who have enjoyed success over the last 40 years are people I've bumped into. So I start there. I, unlike many, really like scale. I am not somebody who is particularly attracted to the idea that you use the cash flow from a small high-grade mine and grow your company. While that's attractive to entrepreneurs, I've noticed that statistically it's an improbability. If you're going to take the risks inherent in junior companies, I want the rewards to be commensurate with the risks. So Specifically, I don't care at all about a deposit that doesn't exhibit $2.5 to $3 billion in situ recoverable reserves and resources already defined. I don't care about small deposits. I don't want to know about small deposits. Mercifully, in the uranium space, there's a whole bunch of big deposits that people don't care particularly about, which I'm attracted to. The best, of course, and I'm not saying that this is an investment recommendation, but the incredible discovery made by NextGen in the Athabasca Basin. This is a world-scale deposit by anybody's estimation. If it wasn't a uranium deposit, if it was a sand and gravel deposit that was in the lowest cost quartile worldwide, had the highest return on capital employed, best quartile return on capital employed worldwide, you'd have to be interested in it. The fact that it's in the uranium business makes it more interesting. The fission deposit next door attracts me. A, because it meets my size criterion, but B, because whoever builds the NextGen deposit will likely have to build the fission deposit simultaneously. Why would you do duplicate overhead, duplicate infrastructure 300 miles away from any infrastructure? Sidebar, of course, the industry built 2 diamond mines in the Northwest Territories, 19 kilometers apart, and they did build duplicate infrastructure. But I'm hoping the uranium business won't be as stupid as a diamond business was. But the fact is that there are 5 or 6 deposits on a global basis that don't need to get any bigger. They need to be advanced. They need to be advanced with term contracts and financed. And I don't think that the market is understanding well enough the fact that unusually these are almost annuity style exercises. There is also, I think, better technology, particularly in the Athabasca Basin, with regards to remote sensing, with regards to targeting. And I think that you're going to see an exploration renaissance in uranium. Those companies haven't been identified to me yet, but I'm paying particular attention to the application of technology in the hands of very skilled technologists. So I think there's all kinds of opportunity there. Having said that, I need to say that with the juniors, the easy money has been made. To make the easy money, you have to pick a hated commodity, and uranium is no longer a hated commodity.
So when you look at Explorcos, if I was to summarize all that, number 1, you look at the management team. Number 2, you look for size and scale.
I do. And I look at a disconnect. If the company's undervalued, I want to know why it's undervalued. If I look at a company, as an example, that has a big deposit in Namibia, and I can allay the lack of market cap to the misperception of political risk on the part of investors, I get that. If I understand what the problem is, I actually feel better about the problem. I can make up my own mind as to whether the market is right or wrong about Namibia. I have to understand from my own point of view what I think the problem is.
Now, another point that you made was the fact that you start with the physical, and the physical has put in a massive move. It's probably up 100%, give or take, since this time last year. But a lot of the stocks aren't really moving in line with that. They're pricing in a much lower uranium price. So I guess my question to you is, do you think the spot market has gotten ahead of itself and it's being driven by exogenous factors? Or do you think there's good value to be found in some of these Explorcos and developers?
I think the spot market may be ahead of itself, but I think it's important to note that it takes a long time to bring new production online. And 2 things have changed. One, 50 million pounds of uranium went to supply heaven because Sprott bought it. So that overhang isn't there. The rest of the overhang on the spot market was Japanese product. When the Japanese shut down their nuclear fleet, their inventory became available for sale. Now that the Japanese have restarted their nuclear fleet, that supply has gone to supply heaven too. So the spot market is way, way, way undersupplied and won't be able to be supplied at all until you see a restart of Kazatomprom and Cameco. And that won't happen until those companies have satisfied themselves in the term market that they can get a reasonable return on capital employed for restarting their hot stopped projects. This is a wonderful circumstance. So although the incentive price for new production at today's interest rates is probably $75 or $80 US, and the spot market at $105 more than discounts the incentive price, the incentive price won't result in new production for between 5 and 7 years because it takes that long to build a deposit. As the volume shifts, as it must, because the spot market's undersupplied, to the term market, that makes successful effort discoveries and development much, much, much more financeable than would occur in the old days where all the transactions were taking place in the spot market. And I don't think that investors have grasped this positive change in fundamentals. Now, it's true that many of the Canadian speculators or the people who speculate in the very junior mining stocks don't care particularly about the reality of construction financing or the differentials between the term market and the spot market. They're interested in sex, they're interested in momentum, all that kind of stuff. At 70 years old, I dare say I'm too old to care too much about sex. I care much more about money. But I do think that the perception around the uranium market will not return to the frenzied levels we saw in the last bull market, precisely because people were punished so severely for being overly optimistic. You'll recall that we went from having 5 companies in the junior space to having 500 companies in the junior space to falling to having 35 companies in the junior space. You'll remember, too, that we had a boomlet market, 2019, 2020, 2021. Those speculators who bought the uranium narrative didn't understand that that uranium narrative would take 5 or 6 years to play out. Their investment horizons were a long weekend, and they were disappointed. And so you have 2 different sets of investors whose perceptions around the market were false, but whose perceptions around the market formed their expectations of the market, which are by now very low. The next range of investors over the next 5 years are going to be uncommon mining investors. They're going to be rational. They are going to look for deposits in the lowest quartile of the cost curve. They're going to look for returns on capital employed at normalized pricing, $75 uranium, that exceed 25% per annum. They are going to look to have 60 or 70% of production bound up in term contracts for 10 years so that the loans involved in construction can be amortized, leaving room left over for shareholders. In other words, the next generation of uranium investors is going to be competent at math.
Rick, you made mention of the fact that the easy money in the juniors has already been made. But what would you tell an investor who has yet to get involved in the uranium market? And, you know, they say, I'm too late. It's already gone up 100, 200, 300%.
It depends on who you are. It is a truism that most speculators don't care about a commodity when they ought to be buying it. It is a truism that the narrative around uranium wasn't apparent to most investors until the price was such that the narrative became less valuable. That's just the way it works. If you're a momentum investor, if what you are looking to do is take advantage of a commodity where somebody later than you is even dumber than you are, the uranium space is no longer for you. You're a year late. Don't get near it. If you are looking for a business that will prosper by providing baseload power, carbon-free baseload power to humanity at a pricing level that can give you 25 to 35% returns on capital employed, then the uranium business is for you. I would say for a rational natural resource speculator or a rational resource investor, that the game is early on. I'm prepared to say that the uranium price has gone as far as it needs to go in the next year. I'm not projecting a precipitous decline, but it wouldn't surprise me to see the spot price decline. I think that investors in the uranium space now need to confine their expectations to reality. They need to pay attention to things like optimized economics between pre-feasibility study and bankable feasibility study. They need to pay attention to the boring stuff like permitting and financing. They need to pay attention to the structure of term contracts. For many resource investors, this is mind-numbing and boring. They would prefer to call their broker and be lied to. But for the real investors, for the real speculators, there is a real step change, a real transformational change occurring in the uranium business that will take some of those 15 companies that I said I think are viable and transform them into, I would say, truly spectacular advanced speculations. These are companies that don't have to go out and find anything. It's been found. These are companies that are valued based on $50 yellow cake in the spot market, as opposed to $75 or $80 yellow cake, never mind $100 yellow cake in the term market. These are companies that won't be subject too much to the vagaries of the spot price because their offtake will be contractually sold to investment credit grade counterparties. This is different than anything that we have seen in the uranium market, or frankly, anything that we have seen in any other commodity market in my career. It's unusual to see oil companies or gas companies sell most of their production in volumetric production payments forward. So it's unlikely for companies even as stable as oil and gas companies to enjoy the predictability of product pricing that you're going to see in the uranium business for the next 5 to 10 years. And that certainty and the visibility of that certainty will change the nature of uranium speculation.
Rick, I want to get your sense now of what you're hearing from investors. You travel all over North America and also Europe, speaking to investors all the time, both retail and institutional. And what's your sense? Do we still have a long way to go in this trade? And I guess if I was to use a baseball analogy, what inning do you think we're in?
I think we're probably in the 4th inning. I suspect that we've come so far so fast that we need a breather. I think we probably need a breather. Even Cameco, which I'm really attracted to, has moved from 8 to 40. That's a pretty good move. A 4-bagger in 3 years is a pretty good move, and the market probably needs to digest these gains. 2, I think that people need to be attracted to uranium for long enough that they get deep enough into it that they can comprehend or care to comprehend the transition that the market is seeing from spot to term. A whole bunch of people are attracted to uranium merely because the price has gone up. Then they say to themselves, if the price has gone up, why does it need to go higher? They need to familiarize themselves with the nitty-gritty of the business before they become excited again. But the business is going to be such a good business, such a cash flow generative business, that I think reality will take care of perception over the 5-year time frame. Over the 18-month time frame, probably not. Now, as you say, I talked to 80,000 investors worldwide who are subscribers of mine at Rural Investment Media. Some of them express outright hostility when I say that the easy money has been made. I suspect because they came late to it. The price action in uranium has now justified the narrative that I was trying to sell them 3.5 years ago. But what I'm seeing with the family offices, the high-quality investors, most of whom, by the way, aren't in the mining business. I know them from the oil and gas business or the timber business. When I sit down with the family offices and I take them through the structural change of the uranium business, when I explain the uranium business as a business, not as a ticker symbol on the TSX, if I explain the changing dynamics of the uranium business to somebody who built their fortune owning lumber mills and talk about the changing structure of the industry, the light bulbs go off. You can just watch them say, oh, right. Ultimately, stock prices follow value, and value creation is changing here in a step fashion manner. So in that sense, I'm seeing real uptake. I mean, anytime I wanted now, I could call Rio Tinto or BHP or China General Nuclear, and I could get a return phone call. But the truth is, I don't know anything they don't know. So there's no particular point in me calling them. Where the change is going to come is in the middle market.
Rick, as we wrap up, I'm going to put you on the spot now. And this is one of the reasons why I enjoy talking with you, because it's such a free-flowing conversation. But the last time we spoke, uranium was at $70. Now it's over $100 a pound. A year from now, where do you think it's going to be?
I'm not ducking the question. I actually have no idea. The price of uranium doesn't have to go higher.
I expect that from a broker, Rick, not from you.
This is at a price where the price is plenty high enough at these interest rates to incent new production, but it's going to take time to incent new production. I think what's going to be a more important question is, what will the contracting volumes in the term market look like over the next 3 years? Because the spot market is an increasing anachronism. It's important in that it shapes the narrative, but it's unimportant in terms of return on capital employed. The spot market isn't where most of the transactions are taking place. And it isn't a market where buyers or sellers express their preference going forward. That's taking place in the term market. The term market is very opaque right now. It's tough even for somebody like me to get information about the structure of individual contracts between, say, Cameco and Duke Power. But that's what you're going to have to do. So while I have absolutely no idea where the spot price is going to be, increasingly I care less, because the outcome of the investments that I'm making in the next 5-year time frame won't be determined in the spot market. They'll be determined in the term market. And by the way, that wasn't a neat exercise in ducking your question. It was just to say that the way I think probably reflects the fact that the spot market is a variable that's important in people's minds, but isn't important in terms of the outcome of their investments.
Well, Rick, that was a great discussion. And I want to thank you very much for spending time with us today. If someone would like to learn more about you and the various services that you and your firm offer, where can they go?
Thank you for that. Go to Rule Investment Media. If you like the way I think about natural resources, you can access it personalized for free. Go to Rule Investment Media, list your natural resource stocks, and I personally will rank them 1 to 10, 1 being best, 10 being worst. If I have an opinion about one of your companies that I think is worth expressing, I'll comment on that company. RuleInvestmentMedia.com, list your natural resource companies. And by the way, at Rule Investment Media, you'll find information on 4 deep dive investment boot camps that we put on every year, and our annual Natural Resources Investment Symposium in July in Boca Raton, Florida, now coming into its 30th year as the premier high net worth retail natural resources investment conference on the planet.
I'm still waiting for my invite to the conference in Boca Raton.
Invited, you're my guest.
Well, once again, Rick, thanks very much.
A pleasure. Thank you.